What to invest in? Derivatives, mutual funds, stocks, bonds, derivatives. Whew, so many ways to invest our money. So if you're as confused as I was long time ago when I started investing, today is your lucky day. We're going to look at 21 investment opportunities. Now I've done about 16 of these. When I was working on my master's degree, we had a lot of corporate finance, and we're talking about microeconomics and macroeconomics, and we talked about derivatives and bonds and how they work. And even I was very confused, even after investing for some 30 to 40 years. So let's take a look. We're going to start with what we call an annuity. So let's start with A, right up there with the annuity. Now, an annuity is basically something that's offered by an insurance company, okay? And the way it works here, as you can see, is you have some money that you put into account, see there, bink, and then the money grows, and it grows because it's set at an interest rate, okay? And then there's immediate annuity right over here, or are we, okay, immediate annuity, there we go. And then there's deferred annuity, which means one is like you're going to get your income now. One means the income is deferred out. And the way it works is you see over here, one, it's offered by insurance companies. So two, you have to put in a larger amount of money, okay? So I've seen them as high as $40 or $50 or $60,000 that they put into these things. Now, there's a percentage that you get out drawn every year, say 10%, and it's at that fixed rate. So you can pull the money out, and the rest of the money stays in and accumulates interest. Now, it's good because it works over time. The problem is some of these are not transferable right there, meaning that after you die, they just stay within the fund, so you basically don't get anything. And annuities are good investments because they're pretty stable, but obviously you have to put in a large chunk of money. Now, over here, we see that there's your death, boom. So we have the idea of life insurance where it goes to other people. Okay, now an annuity is kind of like the insurance, except you're getting the money, except for when you die. Sometimes everything's gone, goes back into the fund. So please invest wisely. There's immediate annuities and deferred. Basically, one means you get the money out on a consistent basis. Deferred means you can push it out for the long run. Now, we're going to look at the idea right now of what is a bond. Okay, right up here. See that? Now, a bond is a fixed income. It's an instrument used by governments and companies. Basically, they borrow money from me and you or investors. So basically, they're like a loan. Like you're the bank and you're loaning these companies for their bonds. Now there's corporate bonds, municipal bonds, treasury bonds, junk bonds, bond funds. Let's take a little bit quicker look back over here. Again, now you're the bank, remember. And what they're going to do is issue a bond with a set interest rate. We call that the yield. And the longer you hold it, the more interest you get. Now basically it works when the maturity date comes and it expires, you get to get your money back plus all that interest. Now 5 there, bonds are rated like A, B, C, D. Think of high school. But we have like triple A and double A. And these rankings basically mean investment grade, they're lower risk. Okay. Junk bonds are higher risk. The higher the risk usually means that there are higher interest rates. And what happens is the Federal Reserve manipulates interest rates by buying or selling bonds. So let's take a look at this a little bit more. So again, the yield, you see up there, the yield is the percentage of income that the investors receive from a bond. It's very fixed. Now, bonds are traded on the open market, meaning you can hold it for a long time. Obviously, the longer you hold it, the more money you make. Or they trade in and out of these. It's kind of an interesting thing. And basically, if you can buy it cheaper than the original amount, let's say $10,000, and you bid it for, say, $9,000, if you hold it over the course of the years to maturity, then you would get that yield. And the daily average of Treasury securities, now this is just Treasury securities from the U.S. government. In 2018, it was $547 billion of trading volume on the bonds. That's a lot of trading. So to understand the economy, basically, bonds are out there everywhere, okay? And what happens is when the Federal Reserve wants to lower or raise the interest rates, what they're going to do is they're going to buy or sell bonds. They're the biggest holder of bonds. All kinds of bonds, government bonds, corporate bonds, treasury bonds. And what they do is they can, if they buy them, that means they're flooding the market with money. So there's all kinds of money out there. So people don't need to borrow money. The interest rates would go up, so more people would want to borrow the money, right? Now, if they're not going to do that, they're like, well, let's see. Why don't we go ahead and sell bonds, okay? So they sell these bonds out at a discount. All these buyers buy them up, and all the money goes in the Federal Reserve. So now all the money's gone. So now people have less money. Now they have less money. They may be more interested in buying, or they may be interested in getting a loan. Basically, they manipulate the interest rates through the buying and selling of bonds. And as they flood the market with money or they pull money out, they do this through selling and purchasing of bonds, not stocks, not commodities, not derivatives, but bonds. So I would encourage you to understand a little more and research that out. Now, the second thing we're going to look at is a CD. CD is a certificate of deposit. Think of a savings account, okay? A collectible is more faddish. It's things that we buy and we hope that the price goes up. So let's start with the CD here. Okay, basically it's pretty simple. You put in a bunch of money. You wait for the period of the CD, say 5 years. At the end of the 5 years, you get your money back plus all the accumulated interest, right? They're very safe, but the money has to stay in that account, right? Now there's liquid CDs. You can see that up over here, pink, the first one. What we call bump up CDs, and then brokered CDs. Basically, liquid means you can pull your funds out at any time without early withdrawal. These are not that common. Bump up CDs means you keep your existing CD in account. You can switch it to higher rates later, right? Brokered means you don't really buy one, but you like a fund of them. So you can buy a bunch of CDs that are packed, keep them in one area. Certificate of deposit, very common way of making money, right? So basically you put in money for a length of time. The banks offer it. Number two, if you pull it out too early, you have a withdrawal penalty. Really good for savings accounts, right? Especially if you don't need your money soon. Now, collectibles, art, jewelry, automobiles, antiques. You basically buy a collectible hoping that it goes up in value, right? The problem is a lot of times are faddish. Whatever is hot, the market goes up. And they're not really liquid, meaning you have to find somebody who's willing to buy your collectible. So what is a collectible? Stamps, okay? Trading stamps, wow. We also have coins. Ooh. We have artwork, okay? We have toys. A lot of people think of toys when they collectible. Even shoes. Now, these are some pretty expensive shoes. $650,000 to $850,000 for a pair of shoes. Obviously, they're worn by some professional athlete. So collectibles are good because you can buy them and hold them, right? Like coins that have a value like gold or silver, they'd be pretty interesting because the gold or silver has some value, the weight value of the gold or silver. And then the increase of the value of a collectible is really dependent on who wants it and when they want it. Okay, so remember that, collectibles. I've tried collectibles, never made a lot of money. It's really hard to sell them and you really have to know the market. Okay, so let's look at the next one, commodities and convertible. Now, a commodity is a raw or traded material that can be processed further. Just think about the stuff you eat, right? It's typically bought or traded by a professional in the industry. Energy is commodity, oil and gasoline, grains and seeds, corn, soybean, wheat, livestock, cattle, metal, gold, copper, silver, palladium, softs like coffee, orange juice, cotton, sugar, even lumber, or other types of dairy products, okay? Those are what we call a commodity. Now, remember, usually they're bought and sold in giant lumps, right? So if you're just buying a little bit, you're really in precious metals. You're not really into commodities. These are more of a trading vehicle. So let's go really quickly to the idea of a convertible. Not car convertible, but basically it's an investment that you have that you can change it or replace it for a different type of investment. Usually we use like the debenture or bond or preferred shares, and they're not really a standard vehicle, right? They're usually given as a choice for people who are investing in something. So let's take a quick look at what I had in the area of doing a convertible. Now, I started a business in Singapore. It was actually an online program that we were working on. I went over to Singapore, went to Indonesia, got some people to start developing a website, was out there trying to get funders, we're trying to get investors to drum up interest in this business. Now, we had an area where people would invest money and they would get shares or percentage in the company, right? Now, sometimes we can offer another thing where they could trade it either for a share in the company, or we had some collateral, some artwork that a friend of mine had that was worth a lot of money. They could actually convert that and get the artwork if they wanted. So basically, it's usually done in a startup company and you can convert it. So if you want to go to Apple, it was a startup, they're like, we'll give you like a 2% of the company or 1 million iPods, right? In other words, you can convert it to something else. Okay, they're not real common, usually again in startups. Now, currency. I love currency. I trade currency quite a bit. So let's take a quick look here. There's hard currency, which is what we're used to, the dollar or the won or the euro. And it's a centralized system with recorded ledger. The America or Europe or EU, they're the centralized system. They make the euro dollar, right? And then recorded ledger means you go to a bank or an institute and your money is recorded. Now, digital currency is a decentralized system, which is basically distributed through what we call blockchain. So you don't really have it in a bank account per se. Now, we do now because of the way it's traded, but that's the difference between a hard currency and a digital currency. Now, the foreign exchange is pretty simple. The dollar's exchanged for the euro. Right here, you can see some of the exchange rates. For example, right up here on the top, I don't know if you can see my little finger here, but right here we have the USD, and then we have the SEC, the Hong Kong, the New Zealand dollar, the Austrian dollar, the Australian dollar, the Canadian dollar, and on the going down, it's what you can exchange $1 for or €1. Now, the exchange rates change a lot. For example, when I was doing this, $1 would buy you 0.83 euros or 83 cents of euro dollars, right? Now, the foreign exchange is very liquid. Money can be traded very quickly everywhere. You can do the FX market, banks, exchange, tellers, even on the black market. You'll see that over here on number 3. And the rate depends on a lot of different factors. So really, you can watch the chart of these things. And if you look up here, you can see the daily trading volume. I like trading the won against the dollar because I live here. So when the dollar gets really strong, I buy more of the won. And then when it reverses, then I can buy my dollar back because my won is stronger. So maybe 1,000 won will get $1. And then I can reverse it, and then maybe 80 cents of my dollar would buy 1 won. So basically, you buy and sell currency. Now, cryptocurrency is a bit different. So we're going to look at this one here by going to this area here. Now, you can see me over here on the corner. So right up here, let's say Rob goes and he wants to give his friend some money, say 0.3 Bitcoin. So he goes in, opens his little wallet, he scans the little address, he fills in the account money, and he sends it. Now, if you go way back over here, now it goes actually in the machine, and then the wallet signs a transaction. And then what happens is it's very interesting. We have these things called miners. And miners, what they'll do is they're going to try to confirm the transaction. And we call that mining. And it's basically a computational process. They need a lot of power, these little mining farms. And basically what they do is they verify that the transaction is in the right computer or node. In other words, there's computers all over. They're all networked together through this system. And then these miners actually basically verify it, like say, yep, it's there, the transaction happened, it's really good, we made sure all the calculations were done and all the digital things lined up. And then down here on the little bottom, they create that Bitcoin. The miner goes in and goes, woohoo, I solved the problem. They get a little bit of Bitcoin. Then you see down there the nodes verify the results of the propagation right there. Right there, right down over here. And basically Laura sees her money. So what is a Bitcoin? Well, anyone can start it. Think of the doggy coin or dodgy coin as I've heard it before. Started as a joke, now it's like 5 cents each. And of course you have Bitcoin and Ethereum and all these other ones. Now, you can buy it or mine it. We talked about mining, where they take these unconfirmed blocks and they go through the chain of the nodes of computers. And they basically say, we solve this hash or the cryptographic function. Basically, they solve it and make it solid. Like, yes, this transaction happened. It is now verified, right? Now, it's still limited for buying and selling. And it's trading quite wildly right now. Most people are using it as a transactional thing to buy it and sell it, more the investing area. They're not really buying it and then using it to buy things. Although I saw there was a couple, I think it's in Germany, they're trying to sell a couple bars and they're asking for Bitcoin. So maybe by the time you're watching this, it might be a form of transaction, form of a currency. So we call that a foreign exchange market. You can even go down to your local bank sometimes, especially larger banks, and find the euro or the yen or some of these more popular currencies. Now, we're going to look at the idea of a derivative and a future. Now, these are a little more complicated, and a derivative is mostly where we're going to hedge our risk, as you can see up here. Futures is more of a guessing game. So let's take a look at a derivative. So what the heck is a derivative? Well, we can see up there on the very top, a derivative is a financial security with a value that is reliant upon or derived from, okay? Derivative, derived from an underlying asset or group of assets. So stocks and bonds and commodities, interest rates, currencies, market indices, all these things really trade in the area of a derivative, okay? And basically the use of derivative, we use like futures and options, and they're basically these contracts, okay? So we'll notice that they actually do a number of things. So basically the first thing you see is that the value of whatever you have is actually valued from something else. Now we call these future contracts options, swaps, or warrants, okay? For example, number 3, if you're gonna sell coffee that you haven't grown yet, you're a farmer, you can base it on any kind of future rate. You could guess the future, or you could sell your coffee in the future for what it costs now, okay? That's what we understand in the area of a derivative. The value of my coffee is derived from what? What people buy now or what people buy in the future? Maybe what people paid for it in the past, okay? So you could buy all the gasoline you need for a year at a certain price, okay? We call this the futures market. So what is the futures market? Here we see Farmer John there, and we see, I don't know, there's Trader Terry over there. And basically, the trader can go, I'll tell you what, I'll buy your corn, Mr. Farmer. I want it on July 11th, 2018. I want 4,000 bushels, and I want to pay $4.50. Farmer says, great, sounds good, let's do it. Now, let's just say it comes along in July, but now the price is $10 for 4,000 bushels. Well, obviously the farmer's like, dang it. I wasn't expecting it to go so high. And the trader's like, woohoo! I can get it at for $4.50, and I can sell it for $10 now. Or they can lose money if it goes the other way. Most of us do not trade in the futures market, but we do in the form of futures contracts, okay? We call that long and short, or stock trading. So long, look, see there, number says long. Think that will go up. You purchase the asset first. If it goes up in a certain time period, you sell it and keep the difference. Short means you think it's going to go down. So let's explain this very quickly. It's a little complicated here. Let's go right back there. Down the bottom where it says short. If you think something's going to go down, okay, You can sell the asset before you buy it. Now, we do this on what we call margins. So if you're going to be a trader in the long and short area and dealing options, you have to borrow money. So basically, you're going to say, I think that, let's go, for example, you're looking at Apple stock. It's $100. And you're like, well, you know what? I think it's going to go a lot lower. I'm short. I think Apple's going to do terrible. So I'll tell you what, I will borrow 100 shares at this price. So it's like minus $10,000 because you borrow them, right? You owe money for the shares. If the price goes down, 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 and then you sell it, say at $80, wow, there's a $20 difference. So you can then get your money back through the $20. You don't own the stock per se, but because you borrowed it at 100 and you sold it at 80, right? So it went down. So basically you made money. Now, if you're long, you're expecting it to go up, right? Now, the problem is if it goes up, 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 and you're expecting to go down, at some point you're going to have to sell that stock, and then you lose money because you wanted it to go down, but it went up. So really, why? It's the future. You're trying to predict the future. Now, I do not trade in this market, but many people do. If you're inclined to do it, please do your research again. And maybe you're really good at predicting things in the future. If you're really good at this, then I say maybe it's a good idea, right? So that we'll call the futures market. Now, equity is basically, there's three terms. Basically, you can call a stock an equity. You can ownership in a private company, that's equity. Or equity is the difference you paid and then the current value. For example, your home. You'll see number one there, the mortgage was $100,000. But the appraised value today is $300,000. That means you have $200,000 equity. You can go to your bank and refinance that mortgage. So what does that basically mean? Well, equity is what builds up over time in value, right? So many people do this in real estate. We'll talk about this in a minute, right? But it's very dangerous. If you refinance your house, there's fees involved. And let's say you take $100,000 out in equity. You're like, I get $100,000 because it's worth way more. The problem is your loan goes way up, so the amount of money you're paying every month goes up. So if you don't invest that money that you took out, like if you just go out and blow it on a vacation, buy a nice car, and it starts losing value and you get a nice bunch of clothes, that's great, but you still owe a lot of money on your mortgage. So we call that equity in the real estate. Now, equity just means the difference from what was bought and what was sold or potentially sold for. We call that equity, okay? So don't be confused with a stock. It also is called an equity. So let's keep going. Now we're going to look at index and IRA. Now, what the heck is an index? Indexes are pretty simple. You'll see up there, one, they're basically a group of different investments that cover the same items, okay? Precious metals, industrials, exchanges, countries. There's indexes like the S&P, the Dow, technology, oil, transportation. Now, basically what an index does is it goes up and down according to the economy. So if you're in tech stocks, they go up and down as supply and demand of technology, right? If you're in COVID-19 and you're in a index that trades, say, pharmaceutical companies, then maybe it's going to go up because everybody was searching for a cure, right? So basically, indexes are very safe. A lot of people use them, and they really help you because they follow the entire industry. Now, usually you make more money just by buying one stock if it goes way up, because in a basket of stocks, let's say car index of automobiles, now they all have to go way up for it to go really high. But if you just own, say, Ford or Tesla, Tesla went way up because it's this one stock. So we call these indexes, okay? Index funds. Now, there's global. You can buy, say, they have like South America, and it's a bunch of companies and things within a global area. Regional would be like the Korea Fund or the India Fund. National, okay? So national actually is more like indices within that company, say the Kopsky, or some of these indexes within the nation, right? The Dow, the S&P, these kind of things. Industries are industry specific, right? Technology, Let's see, software, you can pretty much do electronics, energy, finance. Then there's basically exchanges that are sold as index exchanges. Let me go back there for index funds. Okay. So basically, index funds are a good way to invest, especially if you're really knowledgeable in one area or one industry or maybe one country. Okay. So let's go on really quickly down to the IRA. Individual retirement accounts. Now, traditional basically means you pay taxes later. Roth means you pay taxes now. They're retirement accounts. So until you hit 59.5, you cannot pull out the money without a penalty, except for special situations like a death of a loved one. You might be able to pull out of your IRA. Typically, you cannot. You limited your contributions. It's 6,000 to 7,000, depending on how old you are. And your Roth or traditional accounts, you can invest anywhere. Now, so we're going to look up here a little bit more. Now, both of these have maximum contributions, right? 6,000 to 7,000. There's a deadline for like filing your taxes. That's when you put in your contribution. Basic traditional means this. Your contributions are tax deductible in the year they're made, right? Okay, got that? Contributions are tax deductible in the year that they're made, okay? But then in the future, maybe you're going to pay taxes on these, right? Because that's a traditional IRA depending on where you're at, okay? Now, a Roth IRA basically means that you're not taxed now, but you're going to, you're not taxed in the future, but you're going to be taxed basically right now, right? Because contributions are not tax deductible in the year that they're made. That's how they basically do these two, okay? So it's called a Roth and a traditional. I like the Roth because it's the way my taxes work. So hopefully my future income is not taxed as much as my present income, okay? So those are IRAs. Now we have money markets and mutual funds. Whoa! Now, money market is like a savings account, right? And it's like a mutual fund, but they're a lot safer. And basically, there's an interest that's paid at a fixed rate, monthly usually, or yearly, depends on the money market. And these are good places to store money. They're very liquid. They're very easy to sell. And basically, what a money market does is it buys treasury bills, commercial paper, CDs, corporate bonds, very safe financial areas because they can be liquid, moved in and out. And if you have an account, most accounts like a TD Ameritrade or Fidelity, or if you're in Robinhood, a lot of these, the money you put in there goes into a money market. So you get a little bit of interest. Not a lot, but you get some, right? Now, a mutual fund is different. Now, basically, you're investing money in somebody else's diversified portfolio. It's actively managed, so look out for fees. ETFs are exchange traded funds, which are passively managed. Now, basically, got a bunch of investors on the top. They put all their money, they accumulate it in a mutual fund. Everybody's mutually in there. They get some fund manager. He trades in and out of the market, but they get a percentage, right? So you got to watch those because sometimes it's half to 1%, right? So you're getting a fee no matter what happens. The guy loses money, he still gets a fee because the money you put in there, they do the percentage. Now, it depends on the fund. Sometimes there's like one-time fees, there's reversal fees. They can be a lot, but they can generate returns. It's hard to really find mutual funds because there's thousands of them. Oh, there's a lot of them. For example, bond funds, $4.1 trillion in bond funds. Stock funds, there's $10 trillion. Hybrid funds, money market is $2.7 trillion. These are the different kinds of funds. Now, when we say fund, we can mean a mutual fund or an ETF. Remember, on the far right here, up here you'll see that the ETFs are actively traded in the day. They're like stocks. They buy and sell during the day. Prices fluctuate. They're very passively managed. There's not a lot of fees. Now, mutual funds are only traded or bought or sold basically one time a day, and they do it once per day based on the NAV, which is a rate of return, okay? So basically, they buy them and sell them at one time. They're actively managed. They can be very expensive. ETFs are very popular now because there's not a lot of fees, and people like ETFs. They're just like a mutual fund. Basically, they focus in different areas, okay? And there's thousands and thousands and thousands and thousands of funds out there. It's crazy for everything. Seriously. I'm sure there's one for buying and selling shoes, right? So these are called the mutual funds and market funds. Now, options. Whoo! What the heck is an option? Well, an option explained here. Options are contracts offered the buyer. He has the right, but not the obligation. So we have these things called the buy, call option. Okay, so I'm calling it in, I want to buy it. Sell is like put it away from you. I'm selling it, right? And basically, it allows you to buy shares at a specific time. It's not from like stocks you see on the bottom there, because you don't really own it. It's weird. You basically borrow these things and then you sell them and trade them by basically borrowing them, so you don't really own it. And it says it's a lower risk than stocks. I don't agree with this, because you can withdraw from any point. You have the option to go in and out. So call option, put option. We have this thing called the hold a leverage position. You'll see that. Holding a leverage position, let's go back here on number 4, basically allows people to hedge, because like we talked about the idea of commodities and trading derivatives and things, you have the option to buy them or sell them. So sometimes you can hold on to a position, say oil. You can get like a premium price called a strike price, and then you can buy and sell off that. So it's a very diversified way of trading, okay? It's complicated, but it is very versatile. Now, I don't, again, trade in these, but like I said, if you're really good at like looking at prices and historical values, and you kind of can see what's happening in the future, you're a prognosticator, then maybe you want to trade in these type of options, okay? Now, precious metals is probably a very, 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 very popular way. I haven't looked it up, but my guess is most people own some kind of precious metal. Copper, gold. Of course, gold and silver, we all talk about that. Hey, there's palladium, right? There's platinum, there's indium, there's tin, aluminum, copper. And basically what we do is we buy or sell gold or silver. There's a spot price, which is like it's unfabricated. So bar gold, bullion, nuggets. Now, jewelry is not a spot price. Jewelry means they made something out of it. So that value goes up and down. But precious metal, we can buy them through registered dealers, brokers, or trading platforms. And most people hold them in case of a disaster, right? So it's more of a, like if the market starts tanking and everybody's fear and they're freaking out, a lot of times they buy these kind of things because gold does hold value. People like gold. Silver also because it's used a lot. And those are the two most commonly traded. I have a friend that buys silver, and he's got like giant just bars of this silver, and they're stacked up all over the place, right? Seriously, because it's cheaper. But gold, obviously, you had a big bar of gold, you'd have a lot of money, especially at like $1,800 an ounce. Now, silver now, I think it's like 24, 25. Usually it's in the teens, right? But it's went way up because people have started buying up silver. It's a good thing you can buy and hold it. You can buy a miner as well. That's different ways to do your precious metal, okay? Now, REITs and real estate. REIT stands for Real Estate Investment Trust. We like these. I have REITs. I like REITs. Let me put my little smiley. Here's a nice smiley face like that guy. I like REITs because basically I like real estate. So basically you buy this managed real estate asset. They go out and buy malls or shopping spaces. REITs can buy pretty much anything they want that is real estate. And as it grows through rental income or through changes in interest rates, they make profit, and they have to give out at least 90% or more of their profits. Now, it's not always 90%, but usually around there. So basically, it's a great way to make money. Now, they don't go up and down as much as stocks. They're traded like stocks, REITs, right? And basically, they usually buy and hold like land holdings or rental income, or they buy and sell loans. Very confusing if you get in one of the loan REITs. But they pay a high dividend. If you put your money back in, you can make a lot of money. Now, real estate, you own your own property so you can grow in equity. You can become a landlord. Now, they're not very liquid. It's very complicated to buy and sell real estate. A lot of due diligence. You can buy like commercial real estate. You can lose your shirt if you're not careful because of liability issues. Now, also the cost of ownership is high. It's not like any other investment because real estate, you basically have to maintain it. You have insurance, you have liability insurance and fire insurance. You have to buy it and sell it. So there's processes in escrow when you put your money into a bank or to an escrow company, and then they have to pay off all these different people before you can get your real estate. But let's go really quickly and look at how you make money. Ding, 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 ding. Now, basically, you can increase in market value. That's a good way. Rental income. Woo, a lot of people like that. Okay, and then profits from a business activity. Now, I like this one. So let's look at 10 ways. This is from, let's see, Business Driven Team. I don't know what Business Driven Team is, but I like their little thing I made for them, so you could check them out yourself. Now, short-term rentals. REITs, talked about that. Fix and flip, right? That's where you buy it, you fix it up, and you flip it. I've done this before. Some of them I made a lot of money. Some of them I did not make much money or lost a little bit of money. But you can do that, the flipping market, okay? You can build sites for realtors. Actually, I had an an inspection company. We did building inspections and vacant land inspections and home inspections. I did commercial real estate due diligence, like phase 1 and 2 environmental site assessments, and we did all these different activities. So there's ways you can make money working with realtors. You can crowdfund real estate, which means a group of people going to buy things. You do the loans, buying and selling of loans. You can represent a buyer or seller. We call those agents, right? A realtor. You can be a property manager. You can gather leads for realtors. There's lots of ways to make money in real estate, but obviously it takes a lot of money to be into real estate. Now we're going to look at the last one, which is stocks and yields. Woo! This has been a real fast whirlwind tour. Okay. So a stock, what the heck is a stock? Well, basically it's pretty simple. A public company, they break themselves up into little pieces, number 1. 2, they give an offering with a percentage. Okay, they say give out 10% of the shares. They set a price, say at $10. It goes out to the market. Number 3, people start to buy and sell them. So the price starts, say, at $10, and then it goes up from there, down from there, as people in the market buy and sell them. Great way to build wealth. You can increase in price and then sell it at a gain. I love dividends. Okay, and it's pretty easy to buy and sell. Up here, there's just some terms, and if you look at our stock, we're gonna do one on stock here, a video here. Basically, there's like prices for bid and ask. You see that there. Bull market means woohoo, everybody thinks it's going up. Bear market, when the market goes down. Limit order, so when you buy a stock, you can put a limit order and say, I want to buy Apple stock at $100. You put it in there. And if it hits 100, you hope that you get it at $100. Market order means you're going to put it out there and it's going to fluctuate, but you're guaranteed to buy it. Market order means I really, really want it. I want it now. So you don't really know what you're going to pay for it, okay? Good till canceled means I can go like 90 days and it's going to stay in there. So my limit order stays in there for 90 days until it hits that price I want, say Apple at 100. Day order means you put it in for 1 day and that goes up and down. You either get it or you don't in that day. Volatility just means, if you look at a stock chart, it goes bing, 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 bing. It goes up and down. We call that volatility. Okay, there's even names for that, okay? There's like the beta and then there's the alpha for the stock. We have these little things for volatility. You can actually see how much traded too, how many are traded. Liquidity means, liquid means can you get rid of it fast, right? Some stocks buy and sell fast. Some stocks nobody's heard about and you might not even be able to find a buyer. Trading volume, we talked about that. That's how many bought or sold. You'll see a little graph on the bottom. One shows the price of the stock on your chart. Underneath will be the volume. How many shares traded? So the volume goes up and down on a certain day, depending how popular it is. Going long or short. Long means like, woohoo, we think it's going up. If you're going short a stock, you think it's going down. Leveraging down or leveraging up is really good. We like down because you hopefully, as the stock goes up and down, you can buy share price and you can lower your share price. Sometimes your share price increases if it keeps going up and you keep buying it. Buying it a little bit at a time, basically, is what we call leveraging it. Okay, so stocks are a great way to make money. Okay, usually you have to be in there for a while. It's hard to be a trader. Now, yield just means how much money do you get? Stock, it's called the dividend, right? So if it's a $10 stock, $10 and they pay $1. So 1 divided by 10 is 0.10, meaning 10%. So they yield 10% a year. But as the share price goes up and down, the yield goes up and down, means the percentage that they give you. But a dividend is flat. If they're giving you 30 cents, usually they're set. They're like, okay, you're going to get 30 cents every quarter. You're going to get $1 every year. Or you're going to get 25 cents every 3 months. The set price of the dividend usually gets set. And then the yield, the percentage that you make, it goes up and down with the share price. Remember, if it's $10 a share and it's $1, so you get $1, woohoo, and the share's $10, then it's at a 10% gain, right? If it's, say, a $100 stock and only pays $1, then you're basically getting it at, say, 1%, right? Because it's by percentage of how much the share price is worth. So as the share goes up and down, the yield goes up and down. But the dividends usually stay the same. Now, remember with dividends, they can just stop paying it, say, sorry, we're going to stop, like the banks did in the COVID-19 era, especially in Europe. They just said, sorry, no more dividends. You have to save your money. So they can change. They can go up or down. Now, a bond has a fixed rate because it's a bond. You're buying a bond at a fixed rate. It doesn't really go up and down a whole lot. There are some bonds that have these rates that change, variable rates, but they're not too common. So I just covered very quickly in about 40 minutes, 21 different styles of investing in vehicles. If you're still with me, thanks for being with me for this long. Now, remember, you can go through on your own, and most of it has to do with your own personality. So watch our thing on how your money makes money. I have a video on how your money can make money. You'll see that over here on our YouTube channel. So go ahead and like us. If you like us still and you're with us, click a like. You can also join us and become a subscriber to us at Ideas for Better Living. Thank you. You can also check out our website at omd1meandream.com, where we give you ideas for better living.